inheritance tax, what you need to know, and the simple planning that could save your family thousands of pounds. So what is inheritance tax? Inheritance tax is a tax on the estate, which includes property, money and possessions of someone who has died. The standard inheritance tax rate is 40%. It is only charged on the part of your estate that is above the threshold. The threshold for a single person is 325,000. The threshold for a married couple or those in a civil partnership is 650,000. So an example of a single person who owns a property plus monies. A single person's estate is worth 500,000 and their tax-free threshold is 325,000. She wishes to leave it to her family, her brothers and sisters. The inheritance tax charged will be 40% of what she is over the threshold, which is 175,000. So the tax payable would be £70,000. For a married couple leaving things to each other, who own property and cash. Now between a married couple, if everything passes to the spouse on first death, there is no tax to pay. On second death, if the married couple's estate is worth 900,000, their tax-free allowance is only 650,000. Passing this to family, the inheritance tax charged will be 40% of what they are over, 250,000. That's 100,000 in inheritance tax. Now there are additional allowances. If you are a homeowner and you plan to leave your house to direct descendants, children, grandchildren or stepchildren, you may be entitled to the new resident nil rate band. This could be up to an extra 175,000 per person, but it is subject to strict conditions depending on the value of the house and your marital status. So who pays inheritance tax? Well, the funds have to come from your estate. And this is done by the persons dealing with the estate, called the executors. So how much is your estate worth? It can soon add up. We all own assets. It could be a house, could be investments, could be cash, possibly a property abroad. We may have insurance policies that pay out on first death. We may have pension plans. Or you may even have gifts made in the last 14 years. It's very easy for an estate to add up when you take into account what you own and what pays out when you die. So what is your estate worth? So what can you do to minimise inheritance tax? Well, you can gift monies. It's quite normal for parents to gift their children monies in their lifetime. If you have an inheritance tax liability, you can give away up to £3,000 a year tax-free. If you give more than this, and there is no limit to what you can give, it is subject to a 7-year rule, meaning if you die within that 7 years, there will still be tax to pay. But there are strict conditions on gifting. The person gifting the asset cannot retain the benefit of the gift moving forward. If they do, HMRC will still view the gift as theirs, and it will remain within their estate for inheritance tax calculations. Any gifts will also increase the estate of the person receiving the gift, which could then give them an inheritance tax liability of their own, in effect passing the problem on to the next generation. Now, there are alternative tax planning options. Firstly, lifetime planning. So individuals, number 1, can give gifts out of taxed income, and these are exempt from inheritance tax, and there are no limits to what you can give. Number 2, you can convert ISAs into inheritance tax exempt ISAs. Number 3, you can invest monies that attract BPR, or business property relief. Number 4, you can take out a whole of life insurance to pay the tax bill so the children do not have to. Number 5, marital status, because there is no tax to pay between a married couple or those in a civil partnership. There is also tax planning wills, when you pass your inheritance onto the family. Now, with mum and dad owning a property with cash and possibly investments. Now, passing your estate directly onto the children can increase their estate for inheritance tax, giving them the same issues parents had when trying to avoid inheritance tax. A direct inheritance from parents means the children's inheritance is not protected should they divorce, go bankrupt, or predecease a partner. So we advise that when monies are passed to children, it's done via trusts. By passing via a family trust, the inheritance does not increase the children's estate for inheritance tax. The family trust will also protect the inheritance from being taxed again through each generation, while also protecting their monies should the children divorce or go bankrupt. So our view is, inheritance tax is a voluntary tax. It's only paid by those who do not plan for it. Would you like to know more? Use our contact details on our website to request an appointment for a free home visit or a video meeting.